What prompted this run on Silicon Valley Bank?
Well, firstly, it's great to be with you. And Silicon Valley Bank's saga has really catalyzed over the past week, but people were raising concerns about the bank a couple of months back. So what had happened with Silicon Valley Bank is they were basically in desperate need of money. They were seeing depositors withdrawing their money because those depositors had their own cash needs. They're often startups that need to get money to pay payroll, to pay their own suppliers, to pay their landlords. So those depositors were steadily withdrawing money. Silicon Valley Bank could see that the writing was on the wall. They'd need to raise some cash. So what they did is they sold some of their securities, so some of the bonds they were holding on their balance sheet. Now, bonds are basically loans. Now, what that basically means is if that loan had a very low interest rate accruing on it, but interest rates had gone up in the economy, those bonds will have gone down in value. So they sold a lot of these bonds and made a bit of a loss. Then they went to the market to try to raise some even more money. But the market was kind of spooked by this. The market realized that Silicon Valley Bank was definitely in dire need of money, and then following on from this, a lot of venture capital funds caused their depositors, so the startups, to withdraw their money from Silicon Valley Bank, which then catalyzed a bank run. And hence, on Friday, the regulators stepped in and then took over the bank. So that's really what happened in short. Basically a classic bank run, but really a bank run against a bank that was on very, very shaky foundations, of very concentrated depositors and also a very shaky asset base.
Yes, which is the critical thing, because yet another bank has now closed its doors, also associated with the tech sector. Could this signal a bigger run on banks, or do you think it's just isolated to this particular sector and these particular banks?
There's probably a couple of parts to my answer there. So say we're looking at the collapse of Silicon Valley Bank and also the collapse of Signature, which were the two banks that really went under recently. Now that could have catalyzed an even bigger bank run, because if people feared that the money was going to be at risk, people would take the money out of the smaller financial institutions, the ones that would be more risky, the ones that maybe had more concentrated depositor bases, and then take that money into the bigger institutions. So JP Morgan Chase or Bank of America or Wells Fargo, the big ones that you don't think are going to go under. Now that would create a bit of a bank run more broadly within the economy, and that would create major economic headaches. It would create a bit of a catastrophe if we're seeing broader bank failures. However, to try to stave this off, the Federal Reserve and the Treasury Department in the United States came in and they assured all depositors at Silicon Valley Bank that their money would be protected, and similarly with Signature. And this helped to, at least for the moment, stem any broader financial contagion, at least within these banks. This could easily have gone significantly worse if the regulators didn't step in, but fortunately they did, and that appears to have at least staved off the worst for the moment.
Janet Yellen, the US Treasury Secretary, pointed out that this is a very different scenario to the one that we all remember so well in 2008, where there were, real problems in the banking sector, both here and overseas. Have they put the checks and balances, do you believe, in place, that she's right to say that there isn't a broader problem?
The answer is a little bit multifaceted. So say we're looking at the large institutions, the ones that have over $250 billion of assets. So again, JP Morgan Chase, Bank of America, Wells Fargo, the really big ones, the systemically important institutions. For those institutions, we really do have the checks and balances in place. We have the regulations in place, and those institutions have broadly diversified deposit bases, so they're not just exposed to the tech sector. Furthermore, they need to hedge their interest rate risk. What that means is the value of your assets, as I indicated, the bonds, will fluctuate over time as interest rates fluctuate. In order to mitigate that, you do what's called hedging, which basically means you get someone else to take on that risk. It's like insurance. Now, for these large institutions, they need to go through the hedging process. However, Silicon Valley Bank is a much smaller institution, has under $250 billion worth of assets, and therefore didn't need to do a lot of this hedging, and their disclosures were a lot more opaque. Now, this is strangely enough a function of what happened in 2018, where in 2018, a lot of the GFC-era regulations were actually rolled back. So that basically means that for the larger institutions, you have a lot of the financial regulations in place to prevent something like this happening. But for this smaller category of institutions, there's a much bigger risk. And to some extent, it's a little bit regrettable that some of those regulations were actually rolled back, and we end up with a situation like Silicon Valley Bank.
Yeah, interesting. You know, we know the tech sector is under pressure. We've seen thousands and thousands of layoffs. Another finger has been pointed at the Federal Reserve for their very aggressive interest rate hikes, and that's something that is happening right around the globe. Do you think that has been a problem?
In the Silicon Valley Bank situation, the Federal Reserve's rate hikes were a contributing factor, but I'm not sure they're the causal factor. So by that I mean, when the Federal Reserve was hiking rates, this created a couple of problems for Silicon Valley Bank, but also other financial institutions. One, it reduces the value of those assets, and also two, for many of the depositors, so tech firms, VC-backed firms, those small enterprises, they're often bleeding money, they're not profitable. They need to withdraw their money from their deposits to go out and invest in other things, such as making payroll or paying their suppliers. And for those institutions, they were very hard hit by the higher rates. You then add on to this the other factor, which is that when the rates are going up in the economy, Silicon Valley Bank, but any other financial institution, they need to pay a slightly higher rate on their deposits. Now, clearly financial institutions aren't paying you very much on your deposits, but it is ticking up a little bit, and the cost of capital is going up. By contrast, Silicon Valley Bank had bought a lot of so-called treasuries, that is government bonds, which had very low interest rates and were always going to have very low interest rates. This means they were paying more money for their capital, but they weren't earning as much from what they were lending out, and this creates a cash flow problem for them, i.e. they weren't profitable enough and they weren't taking the hedging steps necessary. So the Federal Reserve's hikes were certainly in the background here, certainly a contributing factor, but the underlying causal factor was Silicon Valley Bank's lack of proper risk management. The fact that they didn't properly foresee what might happen with interest rates, they didn't properly take risk mitigation, so that insurance, that hedging that you would expect. They had a far too concentrated deposit base that was going to be vulnerable to a shock like this. So the risk management is really the causal factor here, rather than the Federal Reserve.
Yeah. And finally, Mark, we know that there are tens of millions of dollars tied up for Australian companies in SVB. Will they be protected too by the Federal Reserve stepping in, by the Treasury stepping in?
The Australian companies within Silicon Valley Bank appear to be protected by the Federal Reserve and the Treasury stepping in. It appears that all depositors are going to be protected here. So that is, all of the money is going to be available. Now, this appears to be a function of an extension of the Federal Deposit Insurance Corporation, now extending to cover all deposits rather than just those with a $250,000 cap. That means that companies like Canva or the 25% of Airtree's portfolio companies that reportedly had accounts with Silicon Valley Bank, they appear to be able to get back their capital. Some of the Australian institutions, Australian companies, had already done this. For example, Crimson Education specifically stated they saw the writing on the wall and then desperately got their money out of Silicon Valley Bank just before it collapsed. So it appears the money is safe at the moment, but of course, many of the details are still being worked through, and it is still theoretically possible that maybe overseas depositors will be excluded, but that doesn't appear to be at all likely at the moment.